now welcome on board Puneet Chhatwal, MD and CEO at the Indian Hotels Company, to talk about how their earnings performance has been. Puneet, hi, morning. Congrats firstly. You've now delivered, 14 consecutive quarters of record performance. Tell me, what are the top structural drivers that ensure this winning streak continues for you?
Well, it always feels good to deliver on what you have promised, and it feels even nicer to know that, to the best of our knowledge, nothing is coming in our way, that the 15th or the 16th would not go in the same way as the preceding 14 have gone.
Right. But tell me, your Q2 revenues are up 12%. It's a 90 bips EBITDA margin expansion. Can margins keep improving even as, renovation and expansion costs rise for you?
Very interesting question, and I'm very happy that you asked this one, because this is the first time in first half of the year we had several of our big machines or big properties, as we call them, which were undergoing renovation. The Taj Mahal Palace, our flagship, had several rooms under renovation, but also the private membership club Chambers. There were around 150 rooms in Taj Palace, which were out of order, of which 120 have been redone absolutely as if they were brand new rooms. 44 rooms in Fort Aguada, some in West End, some in Taj Bengal. So these are all IHCL owned businesses, and the displacement level was high. Despite all this, we've still been able to clock 12% growth. Is definitely a proof that the going is good and our brands are strong, and the traction that we get in our hotels is very, very healthy and robust, and should help us to navigate the rest of the second half of the year in the right direction as we have guided.
Right. But Puneet, your first half RevPAR growth stands at 9%, with your international portfolio doing 11%. Tell me, what's driving the international performance? Is it pricing, occupancies, the mix shift?
Actually, it's very simple. A lot of that growth has come in, for example, on the international front from, let's say, San Francisco. San Francisco as a city had nosedived for the preceding 2 years. It's coming back. It's not at the level it used to be. So there is still room for growth in San Francisco. New York as a market has improved significantly in the last 12 to 15 months, also for us. And what is also doing very good for our RevPAR is the growth in Cape Town. So I think these three assets have done well. A little bit is obviously also the weakening of the rupee against the pound. So London is there, or against dollar-based businesses. So in summary, I could say it's both the market and a little bit of improvement because of the exchange rate.
Right. But if you're relatively newer businesses, right? Ginger, Cumin, Ama Stays, Tree of Life, they've grown 21 to 22% in the first half alone. When you see these turn EBITDA margin leaders like your core portfolio?
Firstly, for the rest of the year, we expect them to grow at 30% instead of 22%. They have always been, EBITDA positive from day one, all these businesses that were launched new. We see no reason that growth will keep happening in margins, and especially Ginger. I've been always very bullish on Ginger, and the results have shown that. We see this brand becoming next year 1,000 crore revenue top line brand with at least 400 crores in EBITDA. The EBITDA number is maybe 40% larger than what used to be the top line number for Ginger 6-7 years ago. So that's the kind of growth that is expected, and the brand will deliver obviously premium margins. The lean luxe part of the portfolio in many locations already does almost 60% margin. So 55 to 60% margin in new Ginger properties is possible, despite a good contribution coming also from food and beverage, because just rooms is easier to do a higher margin. But with all the new gingers, we have cumin as the all-day dining. We have also small meeting rooms, like typical mid-scale property, which is for a target market of 500 million Indians by 2030. So we expect this brand to do very well, and slowly, I think Ama and Tree of Life will follow, but they will also need the 3 to 5 years more, just like Ginger needed the 7 to 8 years to get to the level where it has reached today.
Since we're on the subject of Ginger, it's delivered what, 41% EBITDA margins. And as you call it, it's the lean luxe strategy now. Is that going to be the template for the future mid-market expansion?
It's an important one because India has the highest number of people in middle class in the world. And it is time that we don't think of hotels only as luxury, because the luxury part of the supply is actually sub 10% for entire India. So it's already at 90%, but this is the segment that is, in my opinion, witnessing the fastest growth now and will be the case for the years to come.
Right. But Puneet, you've reached now what, 570 hotels with 46 signings and 26 openings just in first half. Does such rapid scaling risk also dilute service quality, or is the brand architecture strong enough?
It depends. If we want to do chai pe charcha, then it does dilute the service quality. But all the accolades that we have won in the recent past, including Taj being recognized for the fourth time as world's strongest hotel brand, Taj being recognized as India's strongest brand across all sectors with a score which is above 90, which is unheard of, and Brand Finance, which does this, calls us the Ferrari of the hotel sector. So I think the Taj brand has done wonders. Ginger is doing wonders. Service quality, in theory, in books, could come under pressure with rapid growth and acceleration, but it depends where that rapid growth and acceleration is coming from. So Taj is kept very pure at a luxury level, but acceleration and growth has to come at a Ginger, Tree of Life, Gateway, Ama brands. Otherwise, there's no point being in that business. You'd rather get out of that business. So we are very excited with the A&K Pride portfolio that we announced. Hopefully, we'll complete that deal at the end of this month, or at the latest by the end of the quarter. And that will position Ginger into 250 hotels in operation portfolio at the end of next year. So I think that is what is needed to become a brand of a significant scale, covering maybe 150 plus destinations in India. Then that journey would have been, put on the right fast track or acceleration track to become larger and larger and larger. And that's the need for that kind of positioning.
So high tea in true Taj style, right? And not chai pe charcha.
Whatever you want to, high tea or chai pe charcha. I think we all have a certain experience with our brands, and I'm very happy that people, nobody thought Ama would get so much of love and affection from the users, including yourself. So that is, it's like launched not even 5 years ago. So I think brands take time. It does not happen overnight. Up till now, we've been able to do justice, and we actually feel very proud with the leadership position Taj has maintained even on the international front, with the openings of now 2 more hotels in Bhutan, Paro and Phokchika coming next month, followed by Frankfurt in end of February or early March, and then towards end of March, the 2, Taj at the Kruger National Park in South Africa. So I think that's a good going also on the international front. So this makes our brands really very, very interesting and important.
So, Puneet, I mean, the market's wondering that with this sizable 2,847 crore rupees of cash that you have on your books, where do you prioritize capital next? Is it going to be luxury renovations? Is it going to be international beds or asset-light management contracts? And don't say all, you have to pick one.
One, no, but that would be wrong answer. So number one, we have committed to a lot of capex of company-owned projects. And as we speak on 31st of October, we started works on the Bandstand project. Just that one is going to take anywhere between whatever 1,500, 2,000 crores, but it has to be the new iconic project for Mumbai. So if Taj Mahal Palace is the iconic historic luxury, it represents history, then the modern luxury in terms of being iconic has to be represented by Bandstand. Then we have other projects in capital cities like upgrade of Vivanta in Guwahati to Taj, the new Taj in Ranchi, the building of the two islands of Soheli and Kadmat in Lakshadweep. So a lot of our internal accruals that we have currently and the ones which will come in future will go into funding of these assets. Then in the month of October, we have paid the outstanding small loan that we had in London. So that is also paid off. So we are trying to go completely debt free. We have now just a very small debt left in the US, which will also try and level off. So we are completely not net debt free, rather completely debt free. Then finally, this first half, we have spent 250 crores, as I said at the beginning of the conversation, on renovation of our iconic assets. That is something which will continue because if you have such kind of crown jewels in your portfolio, then you have to keep polishing them and keep making them shine throughout. So a lot of deployment of cash, and I think we will still have enough cash to participate in any kind of merger or acquisition opportunities that might come our way besides the A&K and Pride portfolio.
Okay, great to hear that and lots of data points to work with. But thank you, Puneet, for your time today. And congratulations once again on a very